Good morning, everyone, and welcome to our last edition of Between the Lines Live, brought to you by Ray White Commercial. Last one for the year. It's been a big year, and I'm really excited to be joined here today by Ian Hetherington. Ian Hetherington is the director of our RWC Capital Transactions business. So welcome, Ian. And my name is Vanessa Rader. I'm the head of research for the Ray White Group. So let's get started. Yeah. Now, all things 2024. Here we are on the doorstep of Christmas. We've had a bit of a, how shall we say, rocky year, maybe? Is that a nice way of saying it? We know all the research that we've done, we've really seen the reduction in transaction volumes across all asset classes, across all locations, in all price ranges. But the market that's probably fared the worst has probably been that institutional grade part of the market, kind of the sub 50, sub $100 million space. Volumes are certainly being down. So what have you seen this year? I know it's a big question, lots of different asset classes to unpack, sure. But let's start wherever you want to start.
Sure. Merry Christmas, everyone. And sorry about last week. I've been flat on my back with the flu, but it's great to be joining you today.
And therefore you know that we are live because
yes.
we do get sick and there's things that happen. But yeah, so
I think what we've seen this year is just a natural extension of what's come out of the COVID era, where we had record low interest rates, money being pumped into the economy, and now we're dealing with the consequences of that. We're dealing with higher inflation, which leads to higher interest rates. GDP's been low. RBA is fighting inflation. Government seems to be stimulating the economy with a lot of new government jobs, spending heavily, so they're at loggerheads. So I think the choppiness in the market is just a direct outcome of that post-COVID era and just working through those issues.
Yeah.
So if you think about it now, institutions in the CBD were borrowing at around 1.75% during COVID. Those borrowing costs are probably between 5.5% and 6% now. So you can understand how that flows through to yields.
That's right. And while the inflation numbers, on the surface, they look like they're doing better and they're within that band now. Like you said, it's all that injection by the government, that is really kind of propped that up unnecessarily. Not unnecessarily, but it's really quite an artificial number. So while we have the RBA announcement, the expectation is that those rates aren't going to be cut, and they're not going to be cut until much later into 2025.
Yeah, they're stubbornly high. And it feels like that we're not going to get a cut till the second half of next year.
Yeah, that's if you look at the fixed interest and all those sort of things, they've really kind of pushed that out in terms of where those rates are going to be.
5.25%, even mums and dads, people like us can get 5.25% in the bank at the moment. That risk-free rate has an impact on what people will pay for property.
So let's have a look at the different asset classes. So let's start with office. I'm not sure if we want to start with office, but office arguably has been the worst asset. Well, it definitely has been the worst asset class. So you have to look at that occupation across the country. Those of you who hear me speak, I don't really want to talk about Melbourne, but Melbourne's terrible.
Almost uninvestable.
Okay. Melbourne is really tough. Sydney, we're seeing some of that kind of change in that vacancy space again. It's very heavily skewed to that premium end of the market. Not even the prime, it's the premium end of the market.
Yep.
So there is concern of what's going to happen to the rest of the market. But regardless, it's been a hard trot. There's been very, very few transactions take place in the last, say, 2 years even in the major office markets. Were we on the cusp? There's been a couple that have happened later the second half of the year.
Yeah, we've seen a bit of turnover in recent times, and yields generally around that 6.25%, 6.5%.
So for context, they got down as low as?
The lowest deal we did during COVID was 4.1%.
Yeah.
So there's, even at 6.25%, 6.5%, there's a big hit.
Of course. Yeah,
that's
big hit. Huge hit.
So that's, so you can understand why there's been less transactions. It takes a lot of time for people to absorb that. And also purchasers are thinking, well, hang on, can it get worse?
Yes.
Vendors are saying, will it get better? And so you have this sort of treading water inertia that comes into the market which is caused by doubt.
Yes.
Am I doing the right thing?
Yep.
Am I going too early buying? Am I going too early selling? And by the way, if interest rates are just around the corner, well, surely yields are going to tighten.
Yes.
And every month that rug has just been taken away.
Yes, that's right. Yeah, that's an interesting one because no one wants to be the first to show their hand either. They don't want to be the first one in the market that actually does the transaction. And you're right. This whole everyone's talking about second half of this year there was going to be interest rate reductions.
Remember there was all that confidence and froth in the market?
And I remember writing pieces because there was like this stimulus of like excitement coming back in the market, and there was a bit more activity in the smaller end of the market, and we were hopeful that it was going to be like, I remember there's a lot of pieces out there at the moment talking about surviving 25. I remember writing things about it was a surviving 24 and we're going to thrive in 25, but it looks like that's just really been pushed down the road, hasn't it?
It looks like it at this stage.
So office expectations for office in the next 12 months.
So I think it's very clear that you can't throw a blanket over the whole market.
No.
So you've got to break it down a bit. So the premium end of the market is very strong in terms of occupancy. Most of the premium grade buildings in Sydney are at 98%. There's two buildings that are trading under that. One is Gateway at 93%, and the other one's Grosvenor Place, which is dealing with some vacancy from people that have moved out. So, but they've done a lot of leasing in Grosvenor. It's performing very well. So the premium end of the market's very strong. I think all the leasing agents that I trust, they're talking once you get south of King Street, it gets much harder.
Yep.
So that north of King Street, in the genuine core of the Sydney CBD, it's not very good because incentives are so high. So your cash on cash returns are a challenge, but the leasing conditions in the CBD in the core are quite positive as vacancies tightening, and then the secondary markets are the ones where it's proving much more difficult.
Yeah.
So probably this is my third or fourth downturn I've been through. I know I look much younger than I actually am.
Of course.
But flight to quality is always quoted.
Oh, flight to quality.
And of course,
now it's a pivot to premium. That's my new line because it is premium. It's not even just. It's not just the quality in terms of prime. It's premium.
Yeah, pivot to premium's spot on, and we're actually seeing it, and it's meaningful.
Yeah, and so the question remains then, if we have occupancy, well, there's a couple of questions here, but if occupancy is so high in that premium end of the market, are we going to get to a point where new supply is needed for that sort of stock, or do we really need incentives come back? Because incentives at the rate that they are, it's not sustainable.
So the best news for office is all the bad news, which has a certain irony, but it's true. Construction costs, God knows how much have gone up, maybe 40, 50%. Availability of builders is another big challenge.
Of course.
Particularly in Queensland, where
and WA too.
WA, it's horrendous. And lag times, all those things. So what I mean, so just to narrow that down a bit, the bad things being the good things is it seems as though nothing's going to get built for a long time. And that generally creates, and because the lead times are so long in commercial, not only with planning but with construction periods of at least 3 years, we're hoping that at some point in time there's a pressure cooker and a bottleneck in the market, and we see really strong rent growth.
Yeah.
So let's say, I don't know how long that'll be, but let's say it's a couple of years probably.
Let's be nice and vague on that. Let's get down the road.
Yeah.
So what will happen to all those secondary grade office buildings? Like, there's a few things. You can look at it positively, saying affordability is going to become more of a greater concern. So, people have no option but to go to those sort of assets. On the other hand, all these ESG requirements for a lot of the larger businesses will funnel them more into that premium A-grade side of the market. So what means for obsolescence of some of these buildings. And it's expensive to knock something down and start again. It's expensive to retrofit. It's expensive to do all that kind of renovation. What is the future? Do you have a thought on that kind of, not necessarily, like it's the B's in that real hard spot, because there's always a C and D market. There's people that want to occupy that space. There's their own people that own their own, like there's a lot of strata in Sydney and in Melbourne as well. But what about that B grade, which is that perfectly in between and not super attractive to a lot of people?
And residential's been the saviour in previous downturns. But what's the market for not the top end? We all know the top end of the resi market's still really strong, and they're shooting the lights out in places like 1 Alfred Street, record, 100 plus. I think they average about 98,000 a square metre down there or something like that. But is a lot of this stock that's going to struggle in those B and Cs, is that going to be suitable for resi? And what is the cost?
The cost is the
and the cost is the new thing. So what is the actual land value now once I pay my extra? So maybe residential's not going to come and save the day like it has in the past, or if it does, it might take longer. I really think we've got to hope that the number of people coming back to work, and in Sydney it feels real.
Yeah. Well, I caught the training today. I haven't caught the training for ages, and the train was chock-a-block full of people.
Yeah, and so, walking around Martin Place, where our office is, around the city, it does feel a lot more energetic, a lot more vibrancy. Most landlords are indicating that occupancy in their buildings up. So let's hope that this is something that, unlike new supply, this is something we can turn on almost immediately in terms of getting back to work. You can make the decision on Sunday that you're going to go to work on Monday. We can't do that with new supply. So I'm quite hopeful that in another way, bad things, maybe redundancies and these sort of things coming into the market is going to encourage people to get back to work and show their face.
Yeah, I totally agree with that. And that whole, the learning that happens in the office and promotion and stuff,
Correct.
like that will encourage people.
How do you promote someone you haven't met?
Yeah, I totally agree with
or
you.
They don't,
We could have a whole thing talking about this. The other thing on that, though, is that over the last few years, been a lot of businesses that have contracted their space requirements to allow for kind of more flexible working and work from home, that they may not have a desk for every single one of their employees. So if we do have this kind of mass come back into the office, is that going to generate the need for more leasing? And
I think that'd definitely be the case in some businesses. A lot of the bigger businesses, though, have kept the same amount of space because their people are coming in 2 days.
Okay.
So they need to handle when the office is full for those 2 or 3 days.
Okay.
So I think that will have a bit of an effect, and there will be some demand created from that. But I think it might be hard to predict that would be across the board.
Yeah. So we're feeling pretty good about Sydney in that regard then. And in Brisbane as well. So they've already shown itself as being very much back into the office.
Yes.
But Melbourne, we're lagging behind with Melbourne. Sorry, Melbourne viewers. We're going to do a...
Yeah. So look, Melbourne's obviously, I think if we just look at Sydney and take the experience from there, the transactions that are happening are dominated by offshore investors. Melbourne taxes offshore investors hard.
Yeah.
So I think they're going to say, why are we going there? We can go to Sydney, we can go to Brisbane. Okay, they've got a bit of a tax there, but it's less.
Yes.
So I think that and Melbourne's our second biggest market and absorbs a lot of capital.
Yes.
So I think you're going to see increased focus on Sydney and Brisbane because Melbourne's going to be so quiet. Also culturally down in Melbourne, the pressure to get back to work doesn't seem to be as strong. Can't explain that. Don't know why, but maybe because they were locked down for so long.
Yeah, but you'd think that because they were locked down so long, they would want to
Maybe
come back in. But anyway, it's probably a longer lead time down in Melbourne.
Whatever the reason is, Melbourne's slower to get back to work.
Yeah, for sure. It certainly has been.
So I think Melbourne's going to lag the other markets.
Yeah, and the offshore investment, at the end of the day, while the office market is going through a rough trot, Sydney, international city, trophy assets on offer here in Sydney.
Correct.
The market is cyclical. There is the ups and downs. We've seen them before. So that offshore money isn't so scared. Like the downside risk today seems a little less than it was a year ago. Do you know what I mean?
Correct.
So there will still continue to be activity. But watch what happens. With
average A-grade yields at around 6.25%, 6.5%. It's been a number of years since yields were that level.
Yeah, that's right.
Probably since I'll put myself on the spot here. I can't think, but.
No, it's been quite some time.
Yeah, probably 16. Yeah.
Yeah.
Maybe earlier, 12, 14. Yeah.
So, so feeling a bit more optimistic of the office market. A few more transactions do you think we're going to see next year? Or is it just depending on that finance piece?
I think that trend will continue. The banks, ironically, are very aggressive at the moment, most of them, in terms of lending, which you might think is a bit of a surprise. But to the well-capitalised, bigger instos, they're knocking on doors saying, what can we do?
Yeah.
So that's good news. And the margins are pretty attractive, certainly around 1.3%, which is, in historic terms, pretty fair.
Yeah.
So the banks are doing their bit. So you'd suspect that with the valuation cycle where it's at, the valuers have been easing out the vals 1/4 point, 1.25 every quarter, that we're getting in that zone where there's going to be more opportunity for the bid spread to be tighter.
Yes.
And we should see more deals done.
Yeah, good.
There's definite need for people to keep deleveraging and also paying back redemptions. That's a factor in the commercial market because, industrial's been so popular, retail's attracting a lot of money now, alternates are big.
Yeah.
And the market that's perceived to be the one that we're going to sacrifice to go and do these other things as commercial.
Yeah, that's for
So
sure.
I think we'll see an uptick in volumes next year.
Yep. Just on that alternatives piece, I wrote a piece that came out today and talking about that growth in the in the alternatives, and some data that we captured from RIA showed that the portfolios that they've grown to about 14% of Australian property portfolios are now devoted to these alternatives. Data centres being probably the key thing everyone's interested, which brings us to industrial.
Yeah.
So industrial, obviously the favourite flavour of the couple of years, actually.
Yep.
Yields ridiculously low,
Yes.
I can say. In my history of looking at things, I was scratching my head a little bit during that COVID period. But look, it was kind of like a bit of a perfect storm situation because we had occupancy really high, there was no new supply. A lot of our markets are very land constrained, so the availability of vacant industrially zoned land is very limited in most markets, maybe not Melbourne. But so we did see a huge uptick in investment for that kind of big institutional grade stock.
Yep.
That part of the market has really quietened down again over 2024. Not a lot of big kind of transactions occurring. However, the smaller end of the market has been churning along really quite strongly. Owner occupiers, private investors, all jumping into the market, wanting to shelter themselves for any possible rental growth because, as we know, rental growth was so strong the last couple of years.
Amazing.
But we're starting to see kind of some vacancy rear its head a little bit. So, like I said, that big end of the market, probably not an awful lot of transactions, institutional grade, few. No. But thoughts on where has that kind of landed this year?
Yeah, so I think the industrial market's been pretty resilient. And the demand side, you'd imagine, is going to slow. Again, typically you'd say industrial's a proxy for GDP. Mm-hmm. So GDP slowing, demand for new sheds should be slowing. We're seeing a bit more sublease in some of the really big users that were aggressive during COVID and grew. But that's probably pretty limited. I think the number one thing driving industrial is that they're not making any more land.
No.
And that scarcity is still a factor. And that's because of servicing, right? Which
we
is
could have a whole other thing on servicing.
I mean, you want to talk about why we have.
Let's talk about infrastructure.
Let's talk about, inflation and what are some of the factors contributing to that, right? Of course, you can't get your land serviced. So there's people ready to go that can't do anything. So whenever we've got this land shortage problem, I think you would expect industrial is going to outperform.
Okay, so you feel still, and also we have still.
Well, we're not going to see the 20 and 30% rent growth you'd imagine that we've seen.
No. And the yields aren't going to be like they were.
No.
But that rental growth has propped up the returns, though.
Yes.
Over
definitely.
Compared to an office or a retail, we've had this reasonably decent period of time where rental growth has been very, very robust. So while there's maybe some capital growth has come back a little bit, it's really been that total growth number still looks pretty attractive.
And yields are still outperforming commercial.
Yeah.
On like for like, right?
Yeah. Like how crazy.
Yeah. Well.
When was the last time you saw that, hey?
A long time. The first shed I ever sold with a 12-year lease was back in the early 90s, and that was an 11% yield.
There you go. It was always
but interest rates were 8% there.
Yeah. Or what was the office equivalent at that time?
Oh, probably 6. Yeah.
Yeah. There you go.
Yeah.
It is a crazy time, but it's a far more institutional asset class than it ever has been.
Well, that's right. It's emerged so much.
That's right.
Since those days.
And then there's the more sophisticated investments like the data centre piece, where a lot of people are jumping on that. Really strong tenant covenants, and
that's right. Yeah.
That's an alternative. It's an alternative as well. So really diversifying that risk of the portfolio.
Yep. And so data centres are going to become a bigger and bigger part of the market. Look at Goodman's strategy at the moment, very focused on that.
Yep.
And a lot of the new data centres, the AI-related ones.
Yes.
I'm not an expert on data centres, but the little bit I do know, I'm happy to talk about, and that is that they appear to be single level.
Yes.
So they're going to take up a lot more land.
Right. But there is also a bit of a push for. They can be in regional markets. It's very climate driven though. Like if it can be in an area, like I know WA has been kind of spruiked as a location that has, land that would be available to be data centres, as long as it has access to great connectivity, it's got the water and all that power and stuff like that. So, I think it's still a class that's going to continue to emerge. The AI and computers and IT and stuff is not going away; it's only growing. So our requirement, our footprint for these data centres is going to continue.
Where's all the energy going to come from?
Well, this is the thing, and when we talk about ESG as well, it's they're probably not the most socially and environmental attractive. I don't know, we've got to be careful with what we say this, but but look, there's a lot of renewable energy sources that are attached to them as well. So
that's
solar is a big thing. So it has to have access to that, the water recycling, and so they can make them really
Yeah, some of the people
attractive.
we've been talking to have wanted to buy adjoining land to put solar farms on.
Yeah, that's interesting. So watch this space. That's where it's going to be.
So that's going to keep pressure on industrial land values too.
Yeah. So still industrial.
I think industrial should outperform.
Yeah, interesting.
Definitely.
2025, industrial will outperform.
Yep.
You heard it here first.
Yeah, and to that end, selected commercial is. I mean, because it's so dangerous throwing blankets over markets, but. Yeah, there's going to be winners and losers and everything. And don't forget, this is an opportunity to buy assets that you can't normally buy.
Yeah, that's right.
And that's what these repricing that we're going through in the market creates opportunities.
100%. Well, there's winners and losers in all markets, and opportunities are certainly here, and particularly if you have a long-term perspective of things. Like I said, the downside risk for a lot of investments doesn't seem all that bad. Like kind of a lot of that reduction in value has happened in the marketplace. So if you look at a long-term view on things, buying in this cycle of the market is looking pretty attractive.
Yeah.
We haven't got too much time left, but I wanted to. You mentioned retail briefly, and I know that's not necessarily an area that you spend a lot of time in.
I don't even like shopping.
Okay, well, so you stimulating the industrial market with all the
right.
online
That's
retail
right.
and the need for sheds. But retail, and a lot of our research has shown in the last quarter or even the last 6 months of the year, we've seen a real uptick in transaction activity. Smaller shopping centres, not the big kind of major regional, but kind of neighbourhoods, sub-regional spaces. A lot of kind of funds getting out of that part of the market, a lot of private money jumping into it. Do you have an opinion on why that kind of has been?
Yeah, it's interesting. Retail went through the pain probably earlier than everybody else.
It's been so flatlined for such a long time. Yeah.
So I think they've made the adjustments they needed to make, and they've taken the pain. And so I think one of the really attractive things about retail is your cash-on-cash return. In office, your cash-on-cash return is affected severely by incentives and things like that. So the amount of private mum and dad money that's gone into some of these big deals has been amazing, and I think that's because the cash-on-cash returns, what you can actually live on. Yes. Like you can't live on capital growth, but you can live on income, right?
Yeah, that's it.
So I think that's one of the things that's really driven it, and we've seen some very successful but very large syndications take place. And that's been allowed to happen because they took the pain earlier on in the cycle. So I think that we'll probably see retail keep attracting serious amounts of capital. Yeah,
I think so, and particularly those kind of assets that are very convenience-based driven. So like supermarket, like we can see the online numbers. Like our online numbers have kind of stabilised a little bit. Like it's not going away. We're going to continue to grow, but albeit at a slower pace. But people like to be able to, like, particularly those centres where you can drive in and get out, go to the supermarket. Maybe there's a fruit shop next door, butcher, and get your nails done or something. Like very convenient. They seem to have, like, their occupancy seem to be up. They've got food offerings in there. They're becoming a little bit more trendy.
And I think they've also learnt how to adapt to the changes. That's right. There's always a new idea and something to create. And that's one of the great things about retail. And also is the density of the city. Because this is keeps driving demand.
We're not building new retail centres.
No.
Like, do you know what I mean? Like, yes, in some new land release areas there might be a small neighbourhood centre, but our population, we haven't even spoken about this. Population growth has been outstanding over the last few years across everywhere, but we're not building new retail to cater for that. So our per capita is getting less and less and less. So you can make sense that there's more going on, albeit that retail spend per person has come down, but it's still moving in positive territory.
That's right, but if the numbers are still up...
Yeah, the numbers are still up.
We're still growing the way we're growing in terms of population. that's got to be a good thing.
On the
And we're just making things so much more dense.
Yeah.
You know, we're stopping the urban. Well, we're not stopping the sprawl, but
Yeah.
we're slowing it, and we're really focusing on more town centres. I think that's going to be a great thing for retail.
And a lot of those centres as well, they have opportunity, and I think people have a longer term view, is because like those shopping centres of yesteryear that are still there, they're on big parcels of land. They've got a bus stop right at the front. The train station's down the road or something. Like they are really good, redevelopment opportunities.
They're corner blocks in great locations
That's
with
it.
good infrastructure nearby.
So, while residential and their development of residential is a whole nother discussion, potentially they are really great, residential offerings that could, you put the shopping centre back in and looking longer term, they're a really attractive investment play.
Yeah, absolutely. I mean, it's what property is. It's about the land.
Yeah, for sure. And even like you're saying about the changing the mix and things, so we can see the big, Westfields of the world, they've really changed up their offerings as well. So there's far and far less of those clothing and soft goods. There might be a really small store, but all that entertainment and the food and, climbing places and,
all those
all
different things.
different, not just some cinema anymore.
More entertainment focus and different entertainment.
And keeping that dwell time higher as well.
Yeah.
So, certainly an interesting time. And I think that retail's certainly been one of my picks for this year. I think there'll be a lot more activity in that space.
And, there's a number of institutions that are looking at really major refurbishments or expansions. And they're in these growth corridors, which are either because of the Englobo land subdivision in population increases or because of the high density increases. Yeah.
So retail, we're feeling good about retail for next year.
Yeah.
Okay, well, I think that actually takes us to a bit of an end of our discussion, but really interesting. And so office, make it very, very clear, office is, depending on location is key. What we're seeing in Sydney is not necessarily what's happening in Melbourne, and certainly not what's happening in Parramatta and those sort of markets as well.
I think office could swing back really quickly depending on how much, a bit of fear factor about coming back to work and needing to be in the office.
I really feel like that needs to happen more.
Yeah, and that's something that we can turn on
straight away. Like we saw earlier in the year when Amazon in the US came out saying, everyone's got to go back to work, and it was kind of like there was a lot of people that I'm not afraid to say that anymore.
Yeah.
It's certainly an interesting time. I think that you're right with that. We're seeing far more people. There's much more vibrancy in the city, particularly coming to the end of the year. Sometimes it can quieten down a little bit in terms of workers, like people at the shopping strips, but. But anyway, office one to watch, probably a bit more activity happening next year, particularly the latter part of the year when we see interest rate kind of movements. Industrial will still outperform.
Definitely.
Before that kind of the limited supply and lack of the land is definitely going to be the catalyst. Yep. And that small end of the market will continue to chug along. There's a lot of money out there willing to invest. And
again, no land.
No land.
There's hundreds of thousands of hectares waiting to be accessed.
Yes, but can't be serviced.
So until that comes online, industrial's looking good.
And retail certainly if you've read any of some of the pieces I've read, certainly my pick for the year as well. But anyway, thank you very much, Ian.
Yeah,
we appreciate your time and talking about all things 2024 and what we think is going to happen in 2025. This is, like I said, our last Between the Lines live for this year. And we're going to be taking a break, so Merry Christmas to you and your families. Hope you all have a great kind of off period and a bit of some downtime. It's going to be certainly a very warm one. And we'll be back in February with our first one of the year, so keep an eye on the socials and your emails to see what comes out with that one. It'll be a really interesting one. We're going to be talking a bit finance as well, finance and kind of a bit of an outlook for the year ahead and where some of that financing kind of lands as well.
Yeah, that'll be interesting because that's going to be a big determinant 100%. Of activity next year.
Yeah, it will be. So thank you, Ian.
Yeah, thanks,
and thanks again. Have a great break and we'll see you next year.
Merry Christmas.